Everyone thinks a sovereign default looks like a bankruptcy filing. They're wrong. In the real world, a sovereign defaults in three quieter ways. It inflates, it represses, or it restructures behind the scenes. And Japan is now brushing up against the math that makes those doors start to appear. As I record this, January 27th, 2026, no politics, no blame, only mechanics. We're using three inputs you can verify on any serious terminal. Japan's budget math, debt service as a share of spending, stay to the end, because I'll give you a 60-second checklist. The three numbers that tell you whether this story grinds, stalls, or snaps. The status slap, why default doesn't mean what you think. When people hear default, they picture a country running out of money like a household. But a country that issues its own currency doesn't run out of currency. It runs into consequences. So the question is not, can they pay? The question is, what must they sacrifice to pay? Because the sacrifice shows up as a weaker currency, higher inflation expectations, forced buyer behavior in bonds, and eventually a credibility reset. The bomb, a dead market, waking up. Japan's government bond ecosystem is enormous. Roughly Y1.15 quadrillion in outstanding JGBs is the scale being discussed for FY 2026. For years, that mountain felt weightless because rates were pinned near zero. Think of it like a giant snowpack on a roof. At zero rates, the roof barely creaks. Then rates rise a little, and the same snowpack becomes crushing. That's the death cross math. Debt that was effectively free starts charging rent again. Now look at the curve. The 10-year yield has pushed into the high 2% zone, with prints around 2.37%, 2.38% being described as multi-decade highs, and the super long end has been even more violent, with the 40-year flirting with and briefly breaching the 4% line. This matters because duration is leverage. A small yield move on a 40-year bond is a big price move. Big price moves create losses. Losses create forced decisions. Three-layer reality: headlines, plumbing, consequences. Layer 1 is the headline: Japanese yields rise. Layer 2 is the plumbing: mark-to-market losses, collateral haircuts, hedging costs, and margin. Layer 3 is the consequence: what gets sold to plug the hole. Most people live in Layer 1. The action happens in Layer 2. The surprise is always in Layer 3. Here is the non-dramatic mechanism. When yields jump, bond prices fall. When bond prices fall, balance sheets shrink. When balance sheets shrink, risk limits tighten. When risk limits tighten, portfolios sell what they can sell fast. And the first thing to sell is usually the world's most liquid asset, U.S. Treasuries. Not because someone wants out, because Treasuries are the best ATM in a stress event. Microproof stack. The simple way to know this is real. You don't need a narrative. Use this microproof stack. One hard number. Japan's FY 2026 budget allocates about Y31.3 trillion to debt servicing, interest plus redemptions. That's roughly a quarter of total spending. One real-world friction sign: the long end of the JGB market has started to feel air-pocketed. Larger jumps, wider spreads, more nervous auctions, and less comfortable liquidity. One simple explanation: when the cost of money changes after years at zero, the entire system has to reprice risk at once. No villain required. The ratio: debt service eats the budget. Here's the key line: if debt servicing consumes 25.6% of the national budget, the system is no longer steering, it's feeding the bond. And the budget assumptions matter. Japan's fiscal planning is now modeling an interest rate around 3%, levels described as the highest assumption in nearly 3 decades. Why does that matter? Because the market doesn't care what you hope yields will be. The market cares what yields are. At 0% rates, debt service is a whisper. At 3%, debt service becomes a voice. At the wrong moment, it becomes a scream. If yields push toward 3% and stay there, the interest bill can start crowding out everything else, and the math pressure rises fast. This is the death cross logic. The bond market stops being a tool and starts being the constraint. Metaphor: it's like a ship that used to spend a small amount of fuel to stay on course. Then a storm hits, fuel consumption quadruples, and suddenly most of the ship's energy is spent just resisting drift. The back of napkin, why 3%, is a kill zone. Let's do the simplest math on Earth. If outstanding JGBs are roughly Y1.15 quadrillion, then each 1% of average funding cost is about Y11.5 trillion per year. So when the system models 3%, you are staring at a world where the interest load alone can trend toward the mid Y30 trillion range over time, depending on rollover speed and maturity mix. That is not a forecast. It's a ruler. And it explains why markets react so violently to small yield moves. They are not reacting to today. They're reacting to the future coupon stream being repriced. Metaphor: imagine a stadium where the entry fee was free for 20 years. Then the fee becomes small, and then small becomes a toll that repeats every single day. The first day doesn't bankrupt anyone, but the repeating toll changes what the whole city can afford. Open loop. Next, we talk about the spark that made traders stop trusting the funding plan. The funding gap, variable. A small hole that opens a big door. Now we add a catalyst that does not require politics to understand. A proposed suspension of consumption tax on food, discussed as roughly YN 5 trillion, about 32 billion tons, creates a visible gap in the budget. Markets don't punish compassion, they punish uncertainty about funding. When investors see a new hole with no clearly priced plug, no matching spending cuts, no locked revenue offset, they do the only rational thing. They demand a higher yield. That's what people mean when they say bond vigilantes. Not a secret group. Just buyers raising the price of money when the rulebook feels loose. Set piece scene. An auction is minutes away. The book is thin. Dealers look at each other and widen the spread. Not because they know a headline, because they can't model the next 6 months. What this means for you, 15 seconds. A bond market can tolerate bad news. It struggles with unpriced policy risk. When funding is unclear, yields do the talking. Escape. Hatch 1. Repatriation. Asset-rich, cash-poor. Japan can be a net creditor and still be cash-poor at the worst time. Because wealth can sit in foreign assets, while the domestic bond market needs immediate buying power. So when domestic yields jump, there's an incentive to bring money home, sell foreign bonds, buy JGBs, try to calm the curve before it hits the next danger zone. This is where the GPIF factor enters the conversation. When a very large allocator faces pressure to support domestic stability, the easiest liquid asset to sell is often foreign bonds, especially US Treasuries. And here's the crucial point. Even if the motive is domestic, the effect is global. More treasuries for sale, higher yield required to clear, higher US benchmark rates, higher benchmarks, higher mortgages, higher auto loans, tighter corporate credit. That's the contagion channel. Japan doesn't need to export anything intentionally. Flow does it automatically. What this means for you, 15 seconds. Don't ask who is right, ask who is forced. Forced flows beat opinions every time. Escape hatch. 2. Defending the yen, sell dollars to buy time. Now we move to currency plumbing. A rapidly weakening yen is not just an FX chart. It changes import costs, corporate margins, and household purchasing power. So when the yen slides toward widely watched levels, like 155 or 160 per dollar, markets start pricing intervention risk. Here's the mechanical truth. To buy yen, you need yen demand. To create yen demand fast, you spend dollars. To get dollars, you sell dollar assets. That can mean selling US Treasuries from reserves or reserve-like pools. Metaphor: you don't sell your most liquid tool because you hate it. You sell it because it turns into cash today. The signaling ladder: why rate checks move markets. In currency markets, there's a ladder. First talk, then signal, then action. A rate check is a classic signal. It's a quiet question to market makers. Where is the price? How is liquidity? How fast is the move? It tells the street, disorderly motion is being monitored. Signals matter because they change positioning. They force shorts to cover. They make hedgers pay up, and they can buy a few hours of calm. But here's the catch. If the move resumes, the ladder points to action, and action requires dollars, which points again to selling liquid dollar assets. Why American borrowing costs can spike anyway. This is the part that confuses people. How can mortgage rates rise if everyone is nervous? Because the rate you pay is built on benchmarks. When a large holder sells treasuries, the market has to absorb supply. To absorb supply, it demands yield. That higher yield becomes the reference price for fixed mortgages, auto loans, corporate bonds, credit spreads. So the stress can feel like a paradox. Fear rises and yields rise too. That's not a contradiction. That's the market clearing. The hidden accelerant. FX. Hedging turns slow into fast. If you hold foreign bonds, you carry yield risk and currency risk. Many institutions hedge the currency risk. That hedge is not free. When rate differentials shift and volatility rises, hedge costs can rise. When hedge costs rise, the effective yield you earn can collapse. So a portfolio that looked safe on paper can suddenly read lower return, higher risk, more volatility. That's when repatriation speeds up. Not because someone changed ideology, because the spreadsheet changed the trade. This is why Treasury liquidation can go from a rumor to a real flow. It's not one decision. It's many constraints firing at once. What a sovereign default looks like in Japan, 3 doors. Now we answer the title. What does a sovereign default look like here? Door 1. Inflationary default. The central bank expands the balance sheet and the currency weakens, and the real value of debt is paid back in cheaper units. You pay, but purchasing power is the casualty. Door 2. Financial repression. Rules and incentives push domestic institutions to hold bonds regardless of returns. Caps, guidance, liquidity facilities, and structural nudges. You pay, but savers subsidize the system through negative real yields. Door 3. Restructuring by technicality. Not a dramatic bankruptcy, more like extending maturities, smoothing redemptions, and shifting the terms so the cash flow becomes survivable. You pay, but the contract quietly changes. The point is not to predict which door, the point is to recognize the map. Open loop. In Act 10, I'll give you the 3 pathways from here: grind, stall, snap, and the trigger for each. The psychology weapon, why your brain gets hijacked. Your emotions will try to turn this into a story of heroes and villains. That is a trap, because plumbing doesn't care about narratives, it cares about funding. Your brain wants certainty, so it clings to one headline. But systems don't break from one headline, they break from cumulative constraints. The antidote is simple: stop arguing with opinions. Track the 3 numbers. What happens next? Grind, stall, snap. Path 1, grind, yields rise, then stabilize, then edge higher in controlled steps. Trigger, auctions clear, the long end calms, and the yen stops sliding in disorderly bursts. Path 2, stall. Volatility stays elevated, but the market goes nowhere in net terms. Trigger, buyers and sellers reach a temporary balance, but hedging costs remain high. Path 3, snap. A liquidity air pocket hits. Thin bids, sudden yield jumps, sharp FX moves, and deleveraging accelerates. Trigger, long end yields surge, and the currency market forces action. If you're watching US rates, this is why they can rise even when other signals look calming. Global supply meets global stress. The 60-second checklist. The 3 numbers. Here are your 3 numbers to watch. Number 1, the 10-year JGB yield. If it holds near 2.38% or pushes higher, stress is still active. Number 2, the 40-year yield behavior around 4%. If the long end stays above the new zone, the regime is changing. Number 3, USD JPY volatility near 155 to 160. If you see repeated sharp reversals, signaling risk is escalating. These 3 numbers tell you whether the system is calming or tightening. Rapid recap, so you can explain it cleanly. Japan's debt wasn't free. It was priced at 0. Now the price of money is rising. When debt service becomes a quarter of the budget, the bond market becomes the constraint. To buy time, the system reaches for its most liquid asset, foreign bonds, especially US Treasuries. To defend the currency, it may need dollars, which again points to selling dollar assets, and hedging costs can accelerate the flows. That's the math. A Japanese sovereign default won't arrive with a single headline. It arrives as a choice between inflation, repression, or restructuring, because the budget math collides with the yield curve. Comment one word: grind, stall, or snap. What happens next? And if you want part 2, comment map, and I'll build the borrowing cost breakdown, how this becomes real-world monthly payments. One last thought: the market doesn't wait for official announcements. It prices the path. When the budget math tightens, every basis point becomes a vote. Watch the votes, not the speeches, because default, in slow motion, is just math collecting rent, and the clock is the yield curve, cold, silent, always on time. Educational only, not financial advice.